Most business owners think they know business finance until real cash problems show up. The truth is that profit on paper does not mean money in the bank. Cash dies in places most owners never look. That is why only 1% of owners understand the 10 business finance terms in this video. If you are a serious business owner and want more financial control, pay close attention to these 10 business finance terms today. Number 1. Levered free cash flow. Levered free cash flow shows how much real cash a business has left after paying for operations, capital expenses, and debt payments. It is important because you can show accounting profit but have zero spendable money. For example, a business makes revenue of $1 million in a year. After paying costs and expenses, it keeps $200,000 of operating cash. It then buys equipment worth $50,000 and pays debt worth $100,000 for the year. Levered free cash flow is $200,000 minus $50,000 minus $100,000, which equals $50,000. That $50,000 is actual flexible cash. Number 2. Credit line utilization. Credit line utilization tells you what percentage of your credit line you are using at any moment. Banks and lenders watch this number closely. For example, you have a credit line of $200,000. If you are currently using $100,000, your utilization is 50%. When businesses go above 70% utilization for long periods, banks may consider them higher risk because it shows cash dependency. Smart owners keep utilization low or cycle cash faster to free up the line. High utilization reduces borrowing power, hurts credit score, and makes it harder to get better loan terms in the future. Number 3. Operating cash conversion cycle. Operating cash conversion cycle measures how long it takes to turn inventory and sales into real cash in your bank. It includes 3 things: how long inventory sits, how long customers take to pay, and how long you take to pay vendors. If you hold inventory for 30 days, customers pay in 40 days, and you pay suppliers in 15 days. Your cycle is 30 plus 40 minus 15, which equals 55 days. This means you wait nearly 2 months before seeing cash. Shorter cycles are healthier. Long cycles cause cash strain even when sales look strong on paper. This is why businesses fail with profits. Number 4, accrued revenue and accrued liabilities. Accrued revenue means you have earned revenue but have not received cash yet. Accrued liabilities mean you owe expenses that you have not paid yet. Both exist because accounting records work based on when work happens, not when cash moves. For example, you finish a service worth $10,000 in December, but client pays in January. That is accrued revenue. On the liability side, if you owe $5,000 for marketing work completed in December, but you pay in January, that is accrued liability. Owners often ignore accrued items and feel richer or poorer than reality. Accruals let you see true performance without cash delays. Number 5, amortization of intangibles. Amortization of intangibles spreads the cost of intangible assets over their useful life. Intangibles include patents, software licenses, trademarks, or contracts. If you buy a software license for $500,000 with a useful life of 5 years, you do not expense $500,000 all at once. You expense $100,000 each year. This helps show real yearly profitability without large swings. Small business owners run into amortization during acquisitions or when buying technology rights. Even though amortization is a non-cash expense, it affects profit on paper, taxes, and how investors view true earning power. Number 6, Goodwill impairment. Goodwill appears when you buy a company for more than the value of its assets. Impairment happens when that extra value no longer makes sense. For example, you buy a company for $1 million, but its physical and financial assets are worth $700,000. The extra $300,000 becomes goodwill. If later the business loses customers or brand value, that goodwill may drop. If new valuation shows Goodwill worth only $100,000, the $200,000 drop becomes an impairment expense. It reduces profit on paper and signals that the acquisition did not hold value. Number 7. Customer acquisition cost payback period. Customer acquisition cost payback period shows how long it takes to recover the money you spent to get a customer. For example, if you spend $100 in marketing to acquire a customer, and that customer gives you $25 of profit per month, your payback period is 4 months. After month 4, every new dollar is profit. Companies with long payback periods burn cash and need more financing. Small businesses usually skip this metric and focus only on cost per lead or cost per purchase. Payback period tells you if your marketing and growth strategy is financially sustainable or not. Number 8. Aging receivables. Aging receivables shows how long customers have owed you money. Invoices are grouped by time buckets like 0 to 30 days, 31 to 60 days, and so on. If your receivables total $100,000 and 60% is older than 60 days, that is a cash problem. Most small businesses celebrate sales and ignore receivables. Sales without collection equals 0 cash. Aging reports show whether customers pay on time or if you are becoming a free bank for clients. Strong businesses chase collections aggressively and offer early payment discounts to speed up cash instead of waiting months. Number 9. Covenant breach risk. Loans often come with covenants or financial conditions that you must follow. Breach risk means you are close to breaking those conditions. A bank gives you a loan with a rule that your debt service coverage ratio must stay above 1.2. If your profits fall and your ratio drops to 1.08, you are at breach risk. Banks can increase rates, freeze credit lines, demand full payment, or add restrictions. Many owners never read loan covenants and then get shocked when banks reduce funding during bad months. Understanding covenants protects your financing relationships. Number 10. Factoring versus invoice discounting. Both factoring and invoice discounting convert unpaid invoices into quick cash, but they work differently. With factoring, you sell your invoices to a finance company. They collect money from customers directly. With invoice discounting, you borrow against invoices, but you still collect from customers. For example, you have invoices worth $200,000. A factoring company may give you $160,000 upfront and collect the full amount from your customers. With invoice discounting, a lender may give you $160,000 but expects you to repay after customers pay you. Factoring helps with collections, but customers know. Discounting is more private.